Welcome to Sprott Media. I'm Albert Liu. Today is October 12th, 2018, and in the wake of the recent stock reversal, I thought it would be a great time to reach out to Whitney George, Chief Investment Officer of Sprott Asset Management in Darien, Connecticut. Whitney, thanks very much for joining me. How are you?
I'm great, thanks, Albert, and thanks for having me. It's getting interesting.
It is very interesting. So here we are, Friday morning, just before the open here. Two very rough days in the stock market, Whitney. We were 500 or so down yesterday, over 1,000 down over the last 2 days on the Dow. First of all, what do you make of the reversal? What do you think caused it? And how does that change, if at all, how you act in the coming weeks and months?
Okay. To answer the first question, the last question first. Sorry. I'm not much of a market, guru. I'm, more about buying individual securities that I think represent great value. Clearly, a correction is always a good time for me to go shopping, and we've started to do a little bit of that at the margin here recently. What I think has happened is a combination of a number of issues that have been building and but have been ignored by the market that are now coming into focus, maybe for nothing other than seasonal reasons. September, October are often times of a market kind of turbulence. Clearly, the rising interest rate story is not new. You never quite know where the tipping point is, where people take notice. But the recent run-up in the 10-year bonds, from the 280s level up to north of 320, is, in percentage terms, a fairly dramatic move, and seems to have finally caught investors or equity investors' attention. Again, not new, not unexpected. But you never know when they react. Trade wars or trade issues have been with us for at least the last 6 months.
Yeah, Whitney, and we're at the open, over 400 points up on the open. I know you don't like to predict these things, so let me ask you a different question. What does it tell you when we have these violent moves every once in a while? We had it early in the year. Here we have it again in October, which is, I guess, like you said, not too unusual. But are you willing to say that this is normal bull market correction activity, or are you going to read more into it?
Yes, so far it's normal bull market corrective activity. I mean, 10 to 15% corrections are normal. They were somewhat absent, when we had, interest rates at, near zero. Now that rates are rising, it is likely to create a more normal volatility pattern. So, again, if people start to worry about slow or no growth next year, they're going to start to worry about what that means, to our deficits. The promised increased revenue from the tax cuts is yet to materialize and may never. Yet we have $1 trillion deficits for as far as the eye can see, and if you ended up in a recession, that number I've heard could easily go to $2 trillion. And at some point, that's going to have an impact. It may be starting to have an impact on interest rates and our ability to continue to fund our deficits inexpensively. 100 basis points more in interest expense will make it the single largest item on the federal budget, surpassing defense, and that's not a certainty, but it's certainly a probability. So higher interest rates are going to affect PE multiples on stocks.
President Trump put a lot of the focus on the Fed. Actually, I have a quote here. I think he says the Fed is going wild. I'm more of the opinion of they're doing what they said they would do. Where do you land on that? Do you think the Fed deserves criticism for this?
They don't deserve criticism. They're doing precisely what they've said they've done, but, it seems to me that history would suggest that, usually they don't know when it's time to stop until it's too late. And I'm not so sure it's going to be any different this time. And certainly, Donald Trump is not a fan of higher interest rates, for obvious reasons. He's not a fan necessarily of a stronger dollar. Yet those are two widely held, high conviction, conventional beliefs currently. The dollar will stay strong, interest rates will keep going up, and that's kind of where the majority of people have positioned themselves. Yet that's not what Trump would like to see, and he's been getting his way an awful lot this year, and so I think that's those concepts or those convictions may need to be challenged.
It seems like the consensus message I'm getting here from my screen with stock pundits is, don't worry about this. I'm personally not worried because I've got gold. What I'm hearing from you is you're not worried. You find this as a bargain shopper's dream, or at least something that resembles one. Where are you finding the bargains now? You don't have to give me names if you don't want to, but just in general, where are you finding the bargains?
Well, some of the hardest hit areas are of greatest interest. I mean, again, anything in materials, and of course materials would include mining shares, have been brutalized this year. There's been no interest. Obviously with higher dollar and higher interest rates, people have, not been interested in gold until yesterday, when they sort of woke up and were reawakened to its diversification, properties and utility and portfolios. So, certainly that's a beaten, battered part of the market that's of great interest to me. There's some tech hardware companies that have been cut in half this year, whether they be semiconductor, capital equipment providers on fears of a tech slowdown. Companies in the memory storage business have been very hard hit, yet you can't have things working in the cloud and growing data and autonomous driving vehicles and blockchain technology without more storage capacity. So that seems to be sort of an irrational move. And again, some of these companies are trading at 5 times earnings and have dividend yields that are greater than 30-year treasuries. And so for people who are longer term oriented, there's some attraction there. When the market's declining and offering you bargains, it's time to redeploy the capital. We had Apple Computer is one of our largest shareholdings for a very long time. It's still a large holding, but we had to prune some in the last month or so, because again, it became a large enough part of the portfolio that it was becoming oversized, and also the valuation started to approach what I thought was a reasonable price.
Just quickly on Apple, Whitney, David Einhorn apparently has sold his stake on concerns of trade retaliation. How concerned are you about that when it comes to certain of these tech names, especially?
It's a headwind. I'm not so concerned about trade retaliation. I mean, they consumers want Apple's products and services, and so that I don't think that's as big an issue. What could be a big issue is their supply chain. If this gets more serious with China, and all of our U.S. Kind of technology companies need to readjust and rebuild supply chains, domestically, that would be very, very expensive, and obviously not a good thing. But at this stage, they have such a strong global franchise, and again, the valuation is not stretched or extreme like some others in the big cap tech area. I wouldn't be so worried about it. The other part of Apple is their balance sheet. Their ongoing stock buyback, when there are no other buyers in the market, it's comforting to be adding to positions when they're going down, where there ultimately is a buyer, i.e. the company, and they have the capital to do it. They're not using debt, to finance it. There are other parts I'd be more concerned about, in the FANG section, Facebook and Google. I mean, the valuations and growth expectations for these companies way outstrip the practical limitations of the fact that they are based on advertising revenue models. Now, the fact is, Procter & Gamble and General Motors just don't have enough ad dollars to send to companies like this in aggregate to support the growth expectations that are embedded in their share prices.
Whitney, I don't know if Starbucks is a holding of yours, but I wanted to get a comment from you about Bill Ackman's big announcement about his stake in Starbucks.
Bill Ackman, like some others, is a high-profile investor with a very, very mixed, record in the last 5 years. Whether it be on his longs or his shorts, I really, I have little time for, worrying about, what he's doing. Starbucks is a great company, but it's fully valued, and the idea that it's going to double its earnings, in the next 3 years because of China, runs a little bit in the face of all the other things that are worrying the market. Maybe that's a great contrarian play, but I don't get it.
All right, thank you very much, Whitney. Whitney George, Chief Investment Officer of Sprott Asset Management. Thanks for checking in, and please come back again soon. I'm sure we'll have a lot to talk about over the next few weeks.
Thank you, Albert. Always a pleasure.